Assalamu alaikum, myself Isha Jamil, and here we are with the topic of Basel Accords. And we are the group of three members myself Isha Jamil, and the other one Alish Badal, and the third one Khatija Tulkubra. So, today we are going to talk about the Basel Accords as I have told you first. So, let me give you the brief introduction about the Basel Accords. So, we can say that the Basel Accords is a set of international banking resolutions. It is actually developed to ensure the financial stability. It means these accords make sure that the financial institutions have enough capital on account to bear the unexpected losses. Actually, Basel Accords are the series of three sequential banking resolution agreements. These are Basel I, Basel II, and Basel III, set by the Basel Committee on Bank Suspension. So, firstly, we'll go through the brief history of the Basel Accords. As there is a written as the Basel Accords are originated in the late 20th century, driven by the need for international banking standards. The first accord, Basel I, was introduced in 1988. Actually, the Basel Accord was originally organized by the central bankers from the G10 countries who were at that time working towards building new international financial structures to replace the recently collapsed Bretton Woods system, which is now overrated. The meetings are named Basel Accords since the BCBS is headquartered in the offices of the Bank of International Settlements, which is located in Basel, Switzerland. So now we are gonna go through the Basel I. The first Basel Accord, known as the Basel I, was issued in 1988 and focused on the capital adequacy of the financial institution. Actually, the capital adequacy risk is actually the risk that can hurt the financial institution, a loss that can hurt unexpectedly. Categorizes the assets of financial institutions into the five risks categories: 0%, 10%, 20%, 50%, and 100%. Actually, the assets are categorized into these percent, like under Basel I, the banks that operate internationally must maintain the capital equal to at least 8% of the risk weighted assets. Actually, the assets have their own means percentage of risks, like these are actually categorized into 0%, 10%, 20%, or 50%. Okay, so this ensures that the banks hold a certain amount of capital to meet obligations. Now, let me talk about some advantages and disadvantages of Basel I. Firstly, some advantages are like improved risk management, standardization across banks, enhanced financial stability, and the other one is greater transparency. Actually, Basel I was instrumental in making banks more aware of the importance of risk management by bounding the banks to hold minimum capital on their risk level. One of Basel I's great achievement was creating a standardized capital adequacy. This mainly helped banks' financial positions easier to access and compare globally. On the other hand, there are some advantages, so there could be some disadvantages also, like overly simplified risk management, limited scope on risk, and inadequate for complex financial products. Actually, the risk weighted system in Basel I was very broad, placing assets into general categories without detailed distinctions. This approach often led to the inaccurate risk measurements, and Basel I only addressed the credit risk, neglecting the other types of risks such as market and operational risk. Now, the Basel I is completed.
Okay, so my name is Alishbal Sheikh and I'll be talking about Basel 2. So basically Basel 2 is launched in 2004 and its objective is to enhance banking stability, improve risk management and strengthen financial markets. It consists of three pillars. Pillar 1, minimum capital requirements, MCR. Its objective is to ensure banks maintain sufficient capital to cover risks and risk weighted assets calculation, capital adequacy ratio CAR 8% of risk weighted assets in tier 1 and tier 2. Then we have pillar 2, supervisory review SR. Its objective is to ensure regulators effectively oversee banks' risk management. Regulators review bank risk management and capital adequacy, risk assessment and monitoring, capital adequacy evaluation, and then we have market discipline MD. Its objective is to encourage market participants to access banks and risk profiles. Bank disclose risk management and capital adequacy information, and market participant access bank risk profile, transparency and accountability. Okay, so Basel II introduced several advancements in banking regulation, including risk management advancement. So we have four advancement in risk management. Firstly, we have operational risk, that means recognized as a separate risk category. Then we have enhanced credit risk management, that means internal ratings based IRB approach. Then third, we have market risk management, that means improved measurement and capital requirements. Then we have risk weighted assets calculation, that is more sophisticated calculation. Other than this, we have capital adequacy advancement. In this, it is divided into three advancements. So first, we have tier 1 and tier 2 capital definition, clarified capital requirements. Second, we have capital adequacy ratio CAR 8% of risk weighted assets. And third, we have minimum capital requirements MCR, that enhance capital requirements. Then we have supervisory advancement. First, we have supervisory review, pillar 2, enhanced regulatory oversight. Second, we have risk assessment, regulators access banks risk profiles. And third, we have capital adequacy, regulators ensure sufficient capital. Then we have market discipline advancements. So we have transparency in this, that banks disclose risk management and capital adequacy information. And second, we have market participation, that market participants access bank risk profiles. Okay, so here are the advantages of Basel II, that it enhances risk management, encourages banks to improve risk assessment and management. Second, it increases transparency, regular disclosure enable market participants to access bank risk profiles. Third, it improves capital adequacy, that means it minimum capital requirements ensure bank maintains sufficient capital. Fourth, better regulatory oversight. Supervisory review process enhances regulators' monitoring capabilities. That fifth, encourages prudent lending. That means bank must hold more capital for riskier assets. Then sixth, we have promotes financial stability. That means strengthens banking system resilience. Then seven, we have international consistency, standardized regulations, that mean it facilitates global cooperation. Then eight, we have improved credit risk management, that means better assessment and management of credit risk. And it enhance market discipline, that means transparency enable market participant to discipline banks. Then it also encourages bank to diversify, that means it reduces reliance on single asset classes. Then we have disadvantages of Basel II. First, we have complexity, that means it integrate regulations, challenge bank implementation. Second, it higher compliance costs, increase regulatory burden. 3. Potential impact on lending. Stricter capital requirements may reduce lending. 4. We have risk weighted asset criticism. Simplistic approach may not accurately reflect risk. 5. We have pro procyclicality, that means regulations may amplify economic cycles. 6. We have burden on small banks, that means smaller banks struggle with compliance costs. Thank you.
Assalamu alaikum, my name is Khadija Dil Kubra and I will talk about the Basel 3.
Basically, the Basel III is a comprehensive set of banking regulations developed by the Basel Committee on Banking Supervision in response to the 2008 global financial crisis. The primary objective of Basel III is to strengthen the resilience and stability of the banking sector by capital requirements, liquidity requirement, and leverage ratio. Capital requirement increase minimum capital requirements to ensure banks hold sufficient high quality capital to absorb losses. Second one is liquidity requirement. Liquidity requirement introduce liquidity standards to ensure banks maintain sufficient liquid assets to withstand short-term stress. And the last one is leverage ratio. Leverage ratio implemented a leverage ratio to prevent banks from taking excessive risk. Basel III actually represents a significant shift towards strengthening bank regulation, focusing on capital, liquidity, and leverage. Its implementation aims to enhance the stability of the banking sector, mitigating the risk of future financial crises. Now I will talk about the advantages of Basel III. Um, we have basically three advantages. The first one is improved capital, second one is enhanced risk, and third one is increased transparency. Improved capital ensures bank maintains sufficient capital to absorb potential losses. It increased sorry it enhances banks ability to absorb shocks and losses. It reduces risk of bank failure and taxpayer bailouts. It encourages banks to maintain robust capital levels. Second one is enhanced risk management. Enhanced risk management promote effective risk assessment and management practices. It can be better identification and management of risk. It improved credit risk assessment and loan provisioning. It reduced risk of asset bubbles and market instability. The last one is increased transparency. Increased transparency enhances market discipline through improved disclosure. It improves market participants' understanding of bank risk profiles. It enhances investor confidence and market discipline. It supports more informed decision making. By achieving these goals, Basel III aims to reduce systematic risk, enhance financial stability, and promote a more resilient banking sector. Now I will talk about the disadvantages of Basel III, and we can say challenges of Basel III. There are three challenges of Basel III. The first one is compliance cost, second one is reduced lending, and third one is complexity. Um, Compliance cost expenses incurred by banks to implement and maintain Basel III regulation. It increased operational expenses, it reduced profitability, it has potential impact on lending and business growth. The second one is reduced lending. Potential decreases in banks' ability to lend due to higher capital requirements. It reduced economic growth, it increased borrowing cost. It has potential impact on small businesses and individuals. The last one is complexity. Difficulty in understanding and implementing Basel III regulations. It increased compliance burden. It has a higher risk of non-compliance. It has potential for inconsistent implementation. Basel III implementation poses significant challenges for banks, including compliance cost, reduced lending, and complexity. Understanding these challenges enables
regulators and banks to develop effective mitigation strategies, ensuring financial stability while minimizing unintended consequences. Now I will talk about the challenges in implementation. The Basel Accords, a set of globally recognized banking regulations, face challenges in implementation due to variations in national regulations, economic conditions, and the complexity of banking operations. These differences can hinder uniform application, leading to potential regulatory arbitrage among institutions. Um, Variations in national regulation. Countries have unique regulatory environments, making it challenging to implement Basel Accords uniformly. Regulators may exercise flexibility in implementing Basel Accords, leading to consistencies. Variations in supervisory approaches can affect consistency. The second, we have economic condition. Economic conditions such as GDP growth, inflation, and interest rate vary across countries. Countries have different systematic risk profile affecting regulatory priorities. Differences in financial market structures such as banking systems and capital markets impact implementation. The last we have complexity of banking operations. Banks have diverse business models, making it challenging to apply uniform regulation. Other than this, banks' risk management practices vary, affecting regulatory consistency. Besides this, complex financial products require tailored regulations. The last slide we have a conclusion, uh, which I will discuss. The Basel Accords are the cornerstone of global banking regulation, fostering financial stability and resilience. Ongoing evaluation and refinement ensure they remain effective in addressing emerging challenges. It enhances banking stability and resilience. It promotes consistent supervision and regulation. It fosters international cooperation and coordination. It encourages sound risk management practices. The Basel Accords play a vital role in shaping the global banking environment. Ongoing assessment and adaptation ensure these regulations remain effective in addressing emerging challenges. Collaboration, flexibility, and regulatory responsiveness are crucial for maintaining financial stability and promoting sustainable economic growth.